What's going on, guys? It's Justin from Push and Profit. Hope everyone's having a beautiful day today. Now, today, I want to talk about the power of averaging in the stock market. Now, this strategy works with any trading approach you take. So whether you're doing long-term investing or doing short-term swing trades and day trades, you could pretty much average up or down in your position. So I'm going to try to explain this verbally first, but I'm also going to take you guys into my laptop as well to take a look at some real life examples so that you guys could have, a better understanding of how to operate with this strategy. And I'm also going to share a website that I use all the time to help me with this as well, right? So, watch the full video. So basically, when you average down, you're buying more shares at a lower price than what you previously paid, which then lowers the overall price that you have paid in total for that position. And for averaging up, it's the opposite. You're buying more into a position that you already own, but at a higher price. This then raises your average price that you paid in total for that position. Now, most of the time, you're going to want to average down. However, if you're day trading, there's going to be times where you're going to want to average up. But, to better explain all of this, let's go ahead and hop into my computer screen. All right, so we're officially in my laptop screen. And for those of you guys that might ask, I'm using the TD Ameritrade Thinkorswim platform to chart. So again, this is what we're looking at, the TD Ameritrade Thinkorswim platform. Again, you don't have to trade with what I'm trading. You guys could trade with any other brokerage that you would like. This is just what I use, and this is what I'm going to use in the video, right? It's all really the same. It really just whatever works for you, right? Now we're taking a look at ticker symbol SPY, right, which is the ETF for the S&P 500. And right now we're going to talk about averaging down from an investing standpoint, right? So let's say, these red lines right here that I drew, right? Those are my support and resistance lines. So let's just say on this day, which was the 10th, the 10th month of the year, 22nd day of 2020, right? We see that, the market did have a nice little update, right? So let me zoom out. So let's say you bought in right here, right? And let's say you bought in at $342.35, right? But then the market starts falling down, right? And it bounces off this other support area, and then it starts coming up to this higher point. So the way that you would use this approach of averaging down is if you had your position over here, right, and you see that the market's coming down, and let's say you bought in over here after this support area over here, so it lowers your average price, and then as it goes higher, you make a profit, right? So to calculate this is what I use. I use this website, and you guys can save it. I have it bookmarked. It's called onlinecalculator.org, and all this stuff right here. I just have it saved to my bookmark, right? So let's go back to that example. So let's say I said, what was it? Let's just make a new number, $342.50, right? $342, right? So put in the purchase price, $342.50, and let's just say we bought 100 shares, right? Let's just make this very easy, right? So we bought 100 shares at this price. Let's go back to the market, and it started selling off. However, we said that maybe if the market drops 15% down, then we'll cut our loss on this long-term investment, right? We gave ourselves room of 15%, right? Because this is, again, not a day trade, not a swing trade. This is a long-term position. So we're not going to cut our losses at 1%, right? Because, again, we're looking at a bigger picture. We're just going to average down if the market goes down. So we're like, okay, 15% is the max. So the market starts falling down, and it fell down about 6%, right? It was a really bad week, the market starts falling down. So it bounces over here at $322.60, right? So let's go ahead and say we bought another 100 shares and I already forgot the number. I'm getting old. $322.60. So we'll go ahead, $322.60. So again, we purchased first 100 shares at this price, and then another additional 100 shares at a much lower price, right? We're averaging down. So then we'd hit calculate, right? Because we're not going to do this math in our head. We're going to use this website. So it calculates for us that our average price is we have 200 shares, and the average cost for 200 shares when you factor in the two different prices is $332.55, right? So $332. So that's what our average price is. Then the market starts going up, starts going up, starts going up. And now it's at $352.82. So now, we profited $352 all the way from, and again, I already forgot, $332. So $332 is around over here. So from here to here, we made a little 6% profit, right? Because again, we bought in over here. the market did go up, but then it started going down. We bought in again. So our average price was around this area, and the market went all the way up to here. So, we profited over here. So that's how you would average down on a long-term investment, right? Some people call this dollar cost averaging if you're doing this on a longer time frame or a longer scale, right? If you're like investing for years, every time the market goes down, you just buy more shares and you dollar cost average, right? So let's take a look at this. I would say from a swing trading perspective, but again, that was pretty much like a swing trade. A long-term perspective, I guess, would be, just looking at it from a bigger time frame, right? So let's just skip into looking at it from a day trade. Same concept, right? And let's just kind of zoom in. And I have a lot of alerts for S&P or SPY, and that's just because I trade this very often, right? So I know a lot of times when I kind of make these videos talking about, these stocks that I trade, you guys will see I have a lot of alerts set up, and it's not because I want to confuse you guys on the screen. Those are just like the alerts that I use, right? And because I'm obviously a real trader who's just using these alerts, right? So let's kind of find something that I don't trade, just to like make the screen cleaner. Let's look at Square, right? Because I don't really look at Square, but that's not a good example either. Let's look at PayPal, because I want to find something that went down so we could average down, and came back up. But right now I'm kind of having a little trouble, and boom, we found it. Walmart, right? WMT. All right. So again, talking about averaging down, right? Let's say we bought, and let me refresh this screen, kind of make it all 0 so that we could kind of start from scratch, because I don't want to confuse you guys. And we'll do 100 shares as well. And let's take a look at Walmart. So let's say Walmart, we bought in, let's say over here, right? We thought it was going to go up because it bounced off the VWAP above the exponential moving average. So we bought in over here at $145.46. So let me try to remember that. $145, boom, 46 cents. So we bought in over here, but we got faked out, right? It started falling down. So what we could do is then again, if it didn't break your threshold, because again, you don't want things to go too far down, you want to cut your losses, right? But let's say you said, okay, at 3% you'll cut your losses, which is pretty large, but let's just say for that example, right? So this fell down about less than 1%. So perfect. This actually would work. Let's say at 1% we would cut our losses. We wouldn't even average down because this is a day trade. So we'll, like, if it goes below 1% where we bought in, we'll cut our losses. But if it doesn't and it starts showing back up, we'll average down. So we bought in over here. It starts falling down almost 1%, but then it starts coming back up. So let's just say we bought in right over here at this candle, right? Because, we see that it went above the exponential moving average. We're like, okay, cool, things might be going up, right? Or actually, let's just say it right here, right? Like it could honestly be any point, right? But let's just make it simple. Let's say this candle right here. So that was $144.75. So 144.75. 144, boom, 75 cents. And again, we'll do 100 shares. And in reality, when you're doing this, you would put how many shares you bought in, and what your purchase price was, right? So it's not always going to be 100, of course. So when you do that, when you calculate that, the average price in that position now would be approximately 200 shares at $145.10, right? So $145.10. So basically, when it hits here, almost, you're pretty much already at a profit, right? But then it starts coming down, and then it starts going up, right? So now you're at 146.28. So from here, 145.10, I'm gonna try to get it as close, right? To here, you made a profit of almost 1%, right? And that's because you averaged down. You bought in at a higher position, it started coming down. You bought in at a lower position, lowering your average, and then it came back up. So that's averaging down as a day trade. Now, averaging up is what I like to do for more momentum plays, right? Because again, when I'm trading, I don't like to go full in. Let's say I'm trading with an account size of 20,000, right? Let's just make that very clean, simple, 20,000. When I enter a trade, let's say I want to buy in right here. This candle breaks above the VWAP. It's above the exponential moving average. I want to buy in right here at $145.01. I'm not going to put my full $20,000 into this position right away. I'm going to scale in. So let's say I want to scale in increments of, let's just say 10,000, right? I like to divide it by 3 or 5, but let's just say we divided our entire position, our account size by 2. So we're going to enter in this, we're going to scale in 2 times. So we enter $10,000 at 145, $145.05. So let's go ahead and, or it was 1 cent actually. So 145 and 0.7 cents. And actually, let me see how many shares that would be, because we're doing $10,000, right? So we'd do $10,000, oops, calculator, $10,000 divided by 145.1 cent. So that'd be 68 shares approximately, right? 68 shares. And we'll delete this and leave this blank. Going back to the charts. So we bought in right over here. And then let's say, and the reason we scale in when we're trading, or I like to scale in and average up, is because it mitigates your risk, right? Because let's say the position ends up being bad, at least I could cut my losses at 1%. Let's say I want to cut my losses at 1%. I'm only losing 1% of $10,000, versus if I go all in and it ends up being a bad trade and I cut my losses at 1%, then I cut my losses at 1% at $20,000. So it's really just like riding, you use it to scale in to ride up the momentum. So you're like, okay, it's still going up. Okay, some red candles is going down. Then it's showing signs of going up again. So you add in your second position of $10,000, and let's say at $145.63. So let's do another $10,000 divided by 145, and I already forgot, let's just say 145 and 63 cents, okay, and 63 cents. So now we're buying 68 shares at this price. So let's go ahead and go to the site I told you. Let me pull up the calculator. So again, another 68 shares. Calculator, what was it? 145 and 63 cents, 145.63 cents. So we see that we averaged up, right? We are paying about 62 cents more than we did in the beginning, because we're not averaging down, we're now averaging up. And I said that was really just to mitigate your risk, right? So that's a technique I use of scaling in. So let's calculate that. So now my average price is $145.32, right? So really, it's almost as if I put $20,000 around this area over here, and you see that I went up to this resistance over here at 146.23 cents. So that was a profit of 63 or 0.63%, right? So almost 0.5%. So really, you know, you do this to mitigate your risk when you average up. You're really only going to do this when you're day trading. That's really how I recommend it to do it. So that's how you would make your profit. So let's go ahead and clear the screen, and let's just see how much we would profit if we did that. $20,000 times 0.0063 cents, because it's not even a percent. And that would have been $126 that you made in approximately, let's say you bought in over here at $2.55 and you sold over here at $3.50. So in 1 hour, really, which is not bad. You know, $126 in 1 hour is not bad at all. So that's really how you would utilize averaging up for, you know, day trading. And then we already talked about averaging down for day trading, swing trading, and investing. So if you guys have any questions, make sure to leave them down in the comment section below. Again, check out the links in the description below, because I do have a link to our free Facebook group. It's the Push and Profit Facebook group. And in that group, I typically upload a nightly watch list of stocks that have a potential to make a profit. And then on top of that, it's just a community that I'm building of individuals interested in trading in the stock market. So definitely check that out. And with that being said, guys, again, my name is Justin from Push and Profit. Hope you're having a beautiful day today, and I'm out. Take care.